So I hope what Jeff has been talking about has got you thinking, and I hope this is the first time you've been thinking about what's confronting us as advisors. You know, I talk to a lot of advisors all the time, and I've got 3 different responses to what you've heard today. Some of them are in complete denial about it, thinking, oh, it's going to go away, they'll pass a law, somebody will step in, Trump will save us or whoever. Then there's others who say, well, let the chips fall where they may. I'll just be subjected to whatever contract I have to, and I'm not sure that's the route you really want to go either. And then there are people, a lot of you, and I know you're part of that group, that have been tweaking your business, trying to transition some of your business into a model that will be more acceptable under these new rules we have. So, and I appreciate what you're doing in that regard. We at LaSalle have not just started thinking about this. For a long time now, we've been thinking of a way, what do we do as a firm to bring you into this current environment and ourselves into this current environment. And with the hard work of Dan and Mark and Stacy and the help of Jim Caffin and Sortina Analytics, we've come up with what we think is a solution. It won't be an all-in solution, but we think it's a good start to a solution that can help you as you transition business out of a more commission-based and into a world where a fee-based is going to be the soup du jour, so to speak, for our business. So I'd like you like I say, this is a peek at what we're going to be offering. We'll have an official rollout later, but I think it's a good solution, and it's backed up by some good data and research that we brought on board by partnering with Sortino Analytics. So, and I've got a couple of slides I want to show you here, and I want you can read through these, of course. Asset allocation platform, 5 models, the minimums. We think it is very DOL friendly. Fidelity is acting as our custodian on this. This is a proprietary offering. Your clients won't see this anywhere else. And even the research we're getting from Sortino Analytics, you won't see that anywhere else either. These guys are working with us and only us to bring us the research behind this product. It's a low-cost platform. There'll be no transaction fees. All the funds that we'll be using will be no transaction. It will be operated by us, managed by us, under our platform, LSIA. And again, we're partnering with a group out of California, and I'm going to let them talk about what they're doing more in just a minute. But we're really excited about what they're bringing to the table in terms of the expertise that they have in this area and the people that they are using to bring us these results that we give them to allocate into our model portfolios. It is an asset allocation program. There are 5 models, and it's a combination of active funds, and we want to use active funds because that's where we'll get the alpha. And there's also the passive funds, because at times when a fund manager can't deliver us the risk factors in a certain allocation class, we'll go to a passive fund. Why do you use asset allocation? Well, diversification is one thing, but you want exposure to different risk factors in different asset classes. And I know somebody's going to say, well, what happened in 08, 09? Well, the correlations all went to 1 and everything fell through. Right, that's going to happen. But for the most part, asset allocation is designed to give you exposure to different asset classes, different risk factors that are typically non-correlated. And so what we do is we screen a set of thousands of mutual funds, active managers, and we'll ship them off to Sortino, and they'll run a set of formulas, and I'm not sure how many equations you run in that group, Jim, 40 or so.
About 40,000.
40,000 iterations of these funds on monthly data, and they'll bring back to us a group of funds that we'll allocate to the different segments in the asset allocation. You know, large value, mid value, growth, there's an international part, fixed income part. But they bring back to us sort of the sausage that they've made from what we've sent them. And we're really excited about, and we've done some models, and they're working very well right now. We do not have a performance record. There is no track history here. So, you know, I know that's a question that always comes up, but we're real confident in the kind of research that they provided us that these models are going to do just exactly what they say they're going to do. So, but it is 50,000 minimum, and it's a low-cost platform that does give you exposure to active managers without the transaction fees, and we're real excited about that. And so why are we doing that? And of course, the current environment has motivated us to come up with some solution for you who are trying to migrate funds and assets under this platform to a one that's more fiduciary friendly, DOL friendly. Number two, I'd like you to pay attention to there. I've stated in the past that, you know, for the most part, most of you are good portfolio managers, for lack of a better word. But we have a lot that aren't. Some of you are really good, but for the most part, it's kind of split about who's good at managing client portfolios and who's not. But what I do know you're good at is raising assets and working with clients. You're here, your clients are good, you take care of your clients, and that's what we want to be able to do, is to free you up to work with your clients to raise assets, because ultimately that increases your income when you raise assets. But if you're spending time doing research, developing models, doing all that, it's hard to devote as much time that you need for attention to client, for discovering new assets, or even raising new assets. It's a lot of work to try to do the due diligence necessary to come up with a reasonable and objective opinion about one stock, let alone 10 or 12 you're trying to do the work on. And so we know that you're really good at raising client assets and dealing with your clients, and that's what we want to give you more time to. Let us do the work. Let Sortino do the work that develops these models, these portfolios, that gives you time to do what you do best. And we really believe that, and we see evidence of it. Again, we'll have an official rollout later. There'll be a website. We'll have marketing materials with the LaSalle label on it. And Sortino and Jim will be available for webinars or phone calls if you need to. We're really excited about this, and we think it's going to be a partial solution to some of the angst you're having about what's going on in the world of DOL. So with that being said, Jim, I want to bring up Jim Caffin. He's the president of Sortino Investment Analytics. He's 25 years in the business, working with the Wharton Econometric Forecasting Associates, Morgan Stanley, Citibank, Paulie Needleman,
That's right, yeah.
And an ex-football player too. But
Don't hold that against me.
Yeah, so but he's working with some real high caliber people, and the names like Sortino, Sharp, Efron, Ron Sears, who's a member of your staff. All these people are high-powered people who are giants in the world of finance, and we've been able to engage them to help us develop these portfolios, and I think they will do a good job, because we've seen evidence of it already, and we're really happy to have you on. So, Jim.
All right, thank you, Jim.
Oh, yeah.
All right, well, thank you. Thank you, Jim, and thank you for inviting me here. Today, what I'm going to try to do is to introduce you to a new process, and we call it postmodern portfolio theory. I think many of you might be familiar with modern portfolio theory. Well, hopefully, by introducing you to this new process, you'll be able to invest not only your clients' money more confidently, but you'll be able to do it yourselves more confidently as well. So as we've seen over the last few months or last few years, the markets have been like a bungee cord, up and down, really no direction. And what we try to do at Sortino Investment Analytics is to develop a process that will analyze both mutual funds and passive investments more thoroughly, more accurately, and more stringently, so that it will minimize both the uncertainty that exists today in the marketplace and also the emotions that influence investment decision making. Some of the benefits that we think will accrue to you by taking on this process or participating in this model portfolios. As you can see up here, we think that, as Jim said, by not having to do the type of research that we do will allow you to go out and market yourselves as experts in modeling portfolios and developing investment strategies for your clients. In addition, we believe you'll be able to uncover assets that your clients are currently holding that they're not disclosing to you. And I'll get into that in a few minutes. Also, we think client outcomes are going to improve by what we refer to as DTR navigation. And DTR stands for desired target return. Every client has a desired target return that they need to achieve to meet some future cash flow obligation. And that's something that we'll discuss here in a few minutes. We also think that's going to eliminate the cost of doing business. So these are some of the benefits, and as I go through the presentation, hopefully you'll start to recognize it. Now, this is just not our methodology. That's not our philosophy. The brain power that goes into this is some of the best academics and financial experts in the world. As a matter of fact, if I just take a brief look back of why Dr. Sortino decided to explore some of the different methodologies and theories that exist in the world of finance, you'll get a better understanding of how we came to develop this approach. Dr. Sortino got out of college and decided to become a broker. Many of you, back in the 60s, of course not many of you existed then at that time, but Dr. Sortino in the 60s decided to become a broker and sell stocks and bonds. And he had gotten a degree at USC, and he started doing that, and he really, became confused. I mean, he had no clue, really, what was a good stock, what was a good mutual fund at the time, what bond to select. So he decided to go back to school and get a master's in finance. Got his master's in finance at UC Berkeley, and then decided to go back into the business and became a bond trader. Again, he ran into a lot of uncertainty, a lot of emotions even during that time influenced investment decision making. So he decided to go get his doctorate at the University of Oregon. He got his doctorate, and then he decided to travel around the world and to meet with people who had different ideas about investing and creating investment solutions. And so, since he lived in Palo Alto, he decided to call on Dr. Bill Sharpe, who just recently won the Nobel Prize for the capital asset pricing model, had lengthy discussions with him, and he discovered that Bill Sharpe had a new approach to investing, and it's called return-based style analysis. You probably saw in the Wall Street Journal here recently, Jim showed it to me, a big discussion about style drift. Are any of you familiar with style drift and how that can influence the asset allocation of a portfolio? So Bill Sharpe has built what is called a return-based style analyzer. Has about 15,000 equations in it, and it really can break down a manager's performance based on their style. Another individual that Frank talked to at Stanford University is Bradley Efron. Bradley Efron won the Medal of Honor, the Science Medal of Honor here in the United States in 2005. He worked with Frank in a statistical technique called bootstrapping, which I'll demonstrate in a minute. Far superior to Monte Carlo, which incidentally Monte Carlo was developed in 1946. So here's a more recent enhancement to Monte Carlo. He also met with Amos Tversky. Amos Tversky was a partner to Daniel Kahneman. I don't know if many of you are familiar with Daniel Kahneman. He's written several books. He just won the Nobel Prize for Behavioral Finance. And where Daniel Kahneman said that investors need 3 units of return for every unit of risk that they're going to take in the marketplace. That's something that that needs to be considered when investing in clients' assets. Far different than modern portfolio theory, where modern portfolio theory states that investors are trying to make as much money as they can for the given level of risk that they're willing to take on. A lot different. And then Frank went east and met with Dr. Fishburne, and also then met with Kahneman. Fishburne was at the University of Pennsylvania, Kahneman at Princeton. And Fishburne was the first individual to come out with downside risks. not downside to the market index, but downside to the return that the client needed to achieve to reach some financial goal. And he had a slew of formulas that Dr. Sortino took on himself and eventually put it into our optimizer. And finally, one of the key breakthroughs that Dr. Sortino was able to discover on his travels around the globe was at Cambridge University, where he met with John Atkinson and John Brown, who created the 3-parameter log normal return. Now, I know that's a mouthful. We know 2 parameters, and you're all familiar with them, the mean and the standard deviation. Well, there's another parameter that could be used when analyzing a distribution of returns, and that's the frequency and magnitude of the manager exceeding or underperforming the benchmark, which we refer to as the desired target return, that the client needs to achieve to reach some future goal. So our hero then took all this information and put it into one portfolio optimizer. And so we believe that this approach is more thorough, as I said, and let me give you an example. Well, first of all, let me give you just the 4 basic fundamental beliefs of this methodology. Number 1, the goal is not to beat the market. The goal is to identify your client's return that they need on their current assets to meet some future goal. It could be retirement. It could be paying off their home. It could be buying a car. It could be funding their child's college education. That's the key here. Not some market index, but that return that they need. And one of the things that you'll notice here is that those are 4 different financial goals, all requiring different assets, different time frames, different risks that are involved in achieving that. In other words, different tranches of investments. Today, as I said, modern portfolio theory indicates, fill out a risk tolerance questionnaire. That's your investment strategy. You apply it to every financial goal. Somewhat unrealistic. Secondly, the primary risk is not volatility. I know a lot of people use volatility as a key to their investment decision making, but it's not, the real risk is not achieving the client's goal. You can have volatility. As a matter of fact, standard deviation implies that investors are just as happy with bad outcomes as they are with good outcomes. I don't think anybody in this room would agree that investors are happy with bad outcomes. Typically, they don't want any bad outcomes. They want nothing but good outcomes. Our third basic belief is that investments are event-driven, or investment decisions are event-driven. So whatever happens in the marketplace, or whatever happens to the individual's personal life, is going to influence their investment decision-making process. And then finally, we believe that risk tolerance questionnaires ignore the required rate of return. So here's some of the significant advancements of postmodern portfolio theory relative to modern portfolio theory. But there's 2 key elements in this chart that I want you to focus on. In modern portfolio theory, there's really no need to consider the client's current financial situation or their financial needs. That never comes up really in a questionnaire. What comes up is they're willing to take on risks. How much can they lose? So it doesn't really directly relate to, are they investing for a college education for their children, for retirement, whatever the case may be. Some of the things that you can see, and I can more than happy send this presentation to you if you'd like. But these are the 2 key elements that I'm going to be focusing on through the rest of my conversation. So why do we claim that we're a little bit more thorough? Well, as you can see right here, we look at monthly data to start out with. And as Jim said, we can take thousands of money managers, and all we need is 3 years of monthly data, and we can determine the potential for these money managers to add value to your portfolio. So how do we go about doing that? Well, number 1, we apply Bradley Efron's bootstrap technique. And as you can see here, it's a little bit complicated, but what we do is select a month out of each of these 4 years of returns, and we do it 12 times to create an annual return. Now, the way they describe it is randomly selecting a month with replacement. Well, what does replacement mean? It means that once you select a month, it goes back into the pile and it can be reselected. So as you can see here in this example, -6%, even though it comes in the first year, has been selected twice. And so we do this 2,500 times. This is just with one manager. So the calculator is going through this with one manager 2,500 times, and you can imagine if we're doing this with 7,000 managers. But what it illustrates here, and what's important, and why this is so far more superior than modern portfolio theory and the way analytics is done today, because analytics is done today is that they look at performance linearly. And as a month or a quarter gets lopped off, that could influence the performance, the historical performance of a money manager, good or bad. But this, since it looks at it randomly, it can demonstrate that in this particular case, if you did look at it linearly, just year after year, the historical worst year would have been positive 30%, if you look at these 4 years of performance numbers. But what could have happened was a negative 35%. And we back-tested this to the Japanese market in the 1980s. As many of you recall, the Japanese market was just unbelievable. It just year after year after year, double-digit returns. Well, what Efron was able to do was to show that, you know what? You could have a very strong negative year in the Japanese market. As a matter of fact, he predicted that the Japanese market could go down 70%. It actually went down further than that. So what we try to do is be more thorough in our analysis of the money managers. Let me give you an example what this 2,500 annual returns looks like in terms of distribution. So there's really complicated information that's being provided right here. You've got the mean, as you can see right here in the middle, and then you have what we refer to as the required return, or the DTR. So all the returns to the left of the DTR, those are the positive returns that we would be willing to accept. Everything on the other side are the negative returns. But what's interesting here, and you can't see it, is there's this black line that kind of goes over the portfolio. It's kind of right in here. See this black line right there? That's what's called the 3-parameter log normal return. And what that does is identify not only the mean and standard deviation, but one other parameter, which we call the frequency and magnitude that this manager was able to exceed the return that your client needed to achieve their financial goal. And let me give you an illustration of why this is so important. This is just now an example of what the calculator is doing. And this is just with 10 years of data, not 2,500 annual returns for one manager. But as you can see here, Fund 1 has a mean of 10.8%, and Fund 2 has a mean of 10.8%. So which manager do you select? Both have similar standard deviations, 30%. Probability of them achieving this result is 70%. So which manager do you select? Both have similar means and similar standard deviations. And so the frequency and magnitude, the 3-parameter, the third parameter, gives you a better indication of the potential of this manager exceeding the return that your client needs in order to meet their goal. And you can see down here in the potential, the first manager has a potential to exceed a return of 10% by only 10%. In any given year. The second manager has the potential to exceed it by almost 200%. So which manager would you select? And that's what the model does for us. Now this is just on the upside. We do something similar on the downside as well. So we think that this approach is a lot more thorough than the type of analytics that's being applied today with modern portfolio theory. So the second issue is accuracy. And a lot of models get completely corrupted before they even get implemented in the marketplace. And why do I say that? Well, the number of reasons. Number one is that no manager is pure a particular style. How many in this room believe that managers are 100%, for example, large cap value? Okay, I don't think anybody does. But we take this, for example, a manager calls himself large cap value, and we take it as the truth, that they are large cap value. And when we build our portfolios and we want to put a certain amount of assets into a particular style, we ignore the fact that a manager's is a blend of different styles. So how do we go about doing this? And why is this important? For example, in this strategy, we're looking to hire a manager, a mid-growth manager, and we want to place 10% of our assets into mid-growth. But this manager actually, after doing Bill Sharp's return-based style analyzer, 40% of the variance of their performance comes from large growth. 35% comes from small. And only 25% comes from mid-growth. So in reality, when you're thinking that you're placing 10% of your assets into a mid-growth manager, you're only putting 2.5%. Now imagine this if you're doing this for every style out there. Your model is immediately corrupted. Your asset allocation strategy is blown up. And I'll tell you another thing. There's no optimizer in the world today that doesn't immediately corrupt your asset allocation strategy. And the reason is because none of them have centric. How many are familiar with Morningstar's 9 style boxes in this room? Okay? Well, there's that middle, right? And they call it core. Well, they don't include it in their optimization model. No one does. They do the mean variance optimization, but core is not part of it. They have the 9 style boxes there, but they completely ignore it. S&P ignores it, Russell ignores it, and all these big consulting firms, the Wilshires, the Callens, the SEIs, they make a ton of money by going to their clients and saying, you know what, your manager is style drifted. He's not performing well. We got to kick him out. And one of the reasons the manager has drifted is because they don't incorporate centric into the process. So ours does. We're the only optimizer in the world, based on Bill Sharp's style analyzer, that incorporates centric into the process. So why do we think our portfolios are more stringently constructed? Well, as I alluded to earlier, we take into account the different styles of the money managers, but we measure them against a similarly constructed style blended benchmark. And this is really important. Right today, all managers are invested against the S&P 500 or the Russell 1000 or whatever the case may be, whatever index they have out there. And we think that's inherently wrong. We think they need to be measured against a similarly constructed benchmark that's similar to the way they're investing. And let me give you an example here. So here we have 3 large cap value managers. And if you could see those numbers, if you look at manager number 3, he's a large cap value manager, but 32% of the variance of his performance is coming from centric. And remember, I told you centric is not even included in any of the optimizers in the world today. If you have an IPS statement, investment policy statement, and you're dealing with an institution, and you're claiming that this is a large cap value manager, and he's pure large cap value, and 100% of the assets going to large cap value are going to be just large cap value, you violated the investment policy statement right off the bat. And it can't be helped. So if you just look at that particular manager, you can see where you could really corrupt your asset allocation strategy before it's even delivered. So that's important. So there's 2 ratios why we think we're more stringent than anybody else. And I mentioned briefly the upside. You saw the upside potential, an example of that. We also apply what is called the downside potential. And the upside potential just looks at the simple differences above the return that your client needs to achieve. So if the manager exceeded, let's say, a 10% return by 1%, he would get credit for exceeding the 10% by 1%. However, on the downside, we square the results that they fall below the return that your client needed to achieve. So if that manager failed 2% below what they required, it's actually 4%. If they fell 4%, it's actually 16%. So it's very difficult for an active manager to get into the solution set. And finally, DTR alpha is a risk-adjusted return that uses Kahneman's 3 units return for every unit of risk that the client is willing to take on. So we punish the manager 3 units of return against what we call our style beta to reduce the overall return, and this is the result that we get. So as you could see, the manager down here, let's say manager 3, 3.7, that means in any given year, he can outperform the return that your client needs by 370 basis points. Now, we're doing this for 7,000 managers, and we're generating this information through this model. This is what you're competing against in the marketplace today. Other firms are doing their own approach with modern portfolio theory, but as you could tell, it takes a lot of time, a lot of effort to get to this point. So that's the portfolio construction part, and this will give you a sample of what the optimization looks like. And it's kind of difficult to read, but if you see that black line right there, that's inside the blue line, that's a portfolio that has a combination of active and passive managers. And what that indicates is that you're getting more return for less risk by adding active managers. And the reason that that's occurring is because the portfolios are more efficient. They're adhering to the asset allocation strategy there on the right-hand side that we set up to generate the performance that we wanted to achieve for our clients. And so we need to make sure that that asset allocation is adhered to. And that's why we're able to effectively combine or optimally combine both active and passive managers, where the active manager doesn't